You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. Thanks for tuning in. I'm Bill Powers, your host. If you would like to engage the show or the topics that I cover, feel free to email me at bill@MiningStockEducation.com. Well, the gold bugs have been very excited over the last few weeks as a lot of these stocks have doubled off their bottoms, and it's formed sort of a V-shaped bottom off that extreme sell-off that we saw in mid-March. But maybe you're not aware that the uranium stocks, many of them have also had a V-shaped bottom off of their mid-March sell-off. You see stocks that have doubled, gone up 100% in the last month. And we've seen something that we haven't seen in many years in the uranium market. That is the spot price above 30. As I speak today, it's above $31 a pound. And as I look at this market from afar, I ask myself, is this the real thing? Is this the commencement, the start of the uranium bull market that many have expected based on the long-term supply and demand fundamentals? Or is this another head fake? So here with me today to answer that question is Daniel Major. He's the Chief Executive Officer of GoviEx. He has over 30 years experience in the mining industry. Daniel, welcome back to the show. And so is this the head fake or a real thing?
We'll do hindsight on this question, won't we? If you actually look at where we've come from, I mean, we got stuck in this sort of 24 to 26, but we were down at $16 a pound, 2 or 3 years ago when we hit the bottom. So I think what we're seeing now is clearly a reaction to what is already an improving market. We already had strong growth coming out there on the demand side. We're looking at about 2% growth on the demand side, driven predominantly, obviously, by China, India, and Asia. You've had that political change where people now realize that, reactors actually have to stay as part of the clean energy. So the US, France, etc., making sure that the reactors stay in play. And on the supply side, you'd already had the supply side reactions coming through, from a number of mines, and then obviously the last ones we'd seen pre-COVID-19 being Kazatomprom and Cameco reacting to the oversupply in the market that was there. So, I think the big issue that has caught most of us out in this process had been, what Cameco and Kazatomprom were trying to do was clear out the inventory and figure out what was going on there. And so the market was tightening. Volume, certainly when I was talking to traders, they were, saying, hey, 18 months ago, if I wanted to find £1 million to trade, it was not a problem. Now it was a bit first quarter of this year, it's getting tougher to put packages together to make the material needed. I think what you've now seen is as a result of the sharp reaction that's had to be made as a result of COVID-19 and the way that people are having to react to protect their labor force, then obviously the actions by Kazatomprom, by Cameco, by the Namibian mining operators have exacerbated that tightness that was gradually building in this market. So I think, this is not just a head shake. I think what you're seeing is a very clear response to a market that was getting tighter and tighter anyway, and that people have realized actually they need material. One of the things I've commented on previously is that, this year was always going to be, I was expecting the price to go up. But when you looked at the offtake contracts that were out there, most off-takers were quite well covered for 2020 anyway. And therefore, it was as we went out of this year into next, it was going to get harder and harder for people who wanted contract. I was reading an article the other day, and there was an anecdotal comment from a utility basically saying that the suppliers are becoming way more savvy now on contracts and that nobody wants to sign them. So their expectation was that price would have to go up going forward. So I think what you've seen here is obviously that response to the supply side constraint. People worried now. I think what it's also done is highlight what we all understand about our industry, that there actually aren't that many producers in it, and that if you lose, 2 or 3 of them for a short period of time, it puts the whole industry at risk.
I was observing this and I was thinking, looking at it as a game of poker. And I was thinking, did Kazatomprom, when they took their supply offline for a matter of months, at least right now, and then also Cameco taking off Cigar Lake and MacArthur River, taking these offline, is that almost calling the bluff of the utilities that haven't been willing to give them the price that they wanted per pound of uranium?
I wouldn't like to pretend I knew what their total rationale was, but I think in the case of both of them, they will have put their employee safety first, and that's the way they will have looked at it. When you looked at where Cameco were working their way into this process, they were trying to keep their operations going, and then realized that actually it was unattainable for the way that they wanted to operate, and it was actually safer, therefore, to take it down. And because they're not the only operator that we're seeing doing this. I mean, you've seen it across gold, you've seen it particularly across things like copper, where mines are just being shut down all around the world in multiple commodities. And so from that point of view, I think that the driving force with all this management has been their requirement to look after their labor force. Obviously, someone like Cameco, given their action they took at MacArthur River, would understand that there's another impact that comes through here. But they already had a strategy of where they were trying to go, and they, in their view, the market was already starting to tighten up. In the cases of the Namibian operations, both Rossing and Husa, they were forcibly told they had to close. The Namibian government demanded that all operations close, and you've seen the same in South Africa, with the South African gold producers that produce uranium being told to close.
Could what we see happening right now essentially be referred to as a short squeeze within the market? Would that be accurate?
The question that you have really on that is it just a short-term squeeze in per se? We'll just go back to where we were, or is this really a plateau shift, and we've moved up a level? What was clear out there was that inventory levels were dropping around the place in various metals forms, whether it was EUP or UF6. The prices of those commodities forms had already been rising. A lot of that driven by the fact that particularly the US utilities had been picking up material in a more advanced stage because of the uncertainty that had been created by Section 232 and the Nuclear Fuel Working Group. And therefore, by picking up material at an advanced stage, they were shortening their pipeline. So, they could then make a decision within 6 months rather than a 2-year problem to go through. So, and we've seen that because the EUP price has been going up, the UF6 price has been going up. That's been obviously going to be slightly more exacerbated by Cameco's decision to shut down their UF6 operations. So again, that will continue to tighten the market there. And part of the problem at the beginning of this year was that a lot of the utilities were getting their material from those sources rather than the U3O8 source. And it was only as things started really tightening up at the beginning of this year, guys started to look for material. And Cameco, have also, we know they need to buy material. This part of what you're seeing here is people like Cameco being forced to come to buy even more metal than they needed to do. Previously, they would have been on the side watching to take the offer that they could see rather than bidding for material. Because, they don't want to drive the price either. They want the price to go up naturally. And they want to create the scenario that enables it to go up. But it isn't in Cameco's interest to be, forcing it off a cliff, because, as you point out now, with the short squeeze, these things will respond back once you take away the pressure. Your hand stops hurting when you turn off the Bunsen burner. What Cameco wants to do is make sure there's a nice steady fire there that's going to keep going for a very long time. So I think from that point of view, no, it isn't. I think what you're seeing now is, again, inventory being pulled in. Utilities were consuming their inventory, particularly in the North American market, while they tried to figure out what was happening regarding 232 and the working group. And as those inventories come down, obviously they start to get to a point where guys say, well, I've actually got to reload my inventories. I'm getting tight. And therefore, I think what you're seeing here is part of that scenario coming through. Guys are going, well, I actually better start getting some material in and start reloading.
How many million pounds of uranium will we see for demand in 2020? And could you share that with us in relation to what above ground supplies still are there that could potentially supply the market? Because there is going to be a production deficit this year for sure.
Yeah. I mean, you're still looking at about 150 million pounds still required. I mean, if you look at the inventory levels, the Chinese obviously have a big inventory. I mean, what was the last number I saw? About 350 million pounds, but that is strategic. It's not going anywhere. And I think the nuclear fuel work, the WNA report for last year did a very good job at analysing the inventory positions and made it clear really that one of the problems the industry has, when you looked at inventories, was actually, most of it was locked up. And they worked out there was something like 15 million pounds of material that they could see as being really fungible and coming to the market, and the rest of it pretty well stayed where it was. The European and US utilities were at some point well over 2 years of inventory, but that number's coming back down under the 2-year level as well. So, we've seen this already in the secondary supply side, a tightening up, predominantly as well because of particular things like enrichment, for example, where, there's been a capacity squeeze by, various shutdowns coming through. And you're seeing that the whole way through that pipeline. There's been a capacity squeeze all the way through to the underfeeding side as well, with the Russians indicating that most of their underfed material now stays internally because they need it for their industry build out. So, I think it's a case of guys looking at where they are contractually okay, and the utilities now starting to say, well, actually, the price has moved. I've got to come and get it. I've got to meet my contracts. The other thing that clearly was happening at the beginning of the year, and that's why BHP is quite an interesting one with Olympic Dam. If it was to go, they are still a big supplier to the spot market. The Kazakhs had removed themselves, according to the comments they've made, from the spot market. They don't sell there anymore, and so that market was getting tighter. And at the end of the day, the spot market does drive the long-term price. I mean, it's a function of it, because guys have got, utility guys have got a choice. You can buy spot material and predict where it'll be in the future, promise to pay a future price based on your leasing rates, based on storage rates, etc. And that is the forward curve that they're seeing out there. So, when we were down at 24, it made no logical sense to be buying long-term material at long-term prices really for them, because it was cheaper to basically pay someone to store it and pay the cost of money. One thing that has been interesting is that as a result of all the cuts we've seen on interest rates, the leasing rates have gone up because obviously everybody's got a slightly worse credit rating because everybody's in a mess. So we've seen those spreads go from 250 basis points to over 400 basis points. So the cost of leasing material has got more expensive, so that has tended to steepen up the curve a touch as well. But you already got a price now that's actually at 31 is higher than the term contract price that UxC reports.
And what's the average annual cost of production for when you look at all uranium miners globally?
I can't tell you the exact answer. If you look at the curve, obviously you're going to start with the first guys in it, which are going to be the Kazakhs, who are sort of sub $15 to $20. Actually, Red Cloud put an interesting presentation out on their recent webinar that they did, where they had a slide and showed that if you take the existing projects and to get 90% of the material that needs to be mined, you have to get up to $60 cash cost to get all that material to cover the line, which I thought was an interesting chart. Most of that material, you're sitting with a big batch sort of at $20, which is the Kazakh material, and then you've got a very large batch at about $30 to $40.
So what price uranium would we need to see to really incentivize and see the bankers fund uranium development projects?
Obviously depends who they are and where they are. In our particular case, the strategy we've taken is kind of being led by what Cameco have been saying, which is that, to bring MacArthur River back, they would like to see something with a very high 4 or a 5 on it. And therefore, I basically said, for Madawaela, we need to see something that, a mine that works for under $50. If you look at a lot of the projects that were shut down around the world, they were shut down with uranium higher than $50. Certainly a lot of the North American ISR projects. We've looked at a couple ourselves. They need $60 to really justify restarting them and getting them going. So, a price north of $50 is needed to get most things up and going.
When you look at what we're looking at right now and the potential upcycle that we're facing here, what are some of the main differences than 2007? Because a lot of uranium speculators look back and see the parabolic move of 2007 and could overlay that upon what we're seeing here. Some are more conservative. I've seen some that say they think it's going to outdo 2007. Back then we had, the speculators, I understand, drive the price up, but I don't believe we had royalty companies and things like that in the uranium space. So what are some of the key differences that you see?
I think the key difference, well, one, you were really just balancing your market. You had a market that was where supply was driven by a limited number of players, really, at the time, way less than there are now. You had additional material that was being fed gradually into the market by the government, particularly the US government, which was meeting the needs for the reactors. And, there was not a lot of inventory around at the time either. So you were coming into this scenario, and you saw that in things like copper at the same time as well, where supplier inventories were non-existent. And so therefore, when you had a shock that you had then with Cigar Lake disappearing, it was a major impact because there was nothing out there else to feed the market. And so you suddenly had this rush up on price as everybody panicked where they were actually going to get their material. You had a strong build out on reactors going on at the time. The problem we've had in this time around is that we have had to deal with the inventory question more than we had before. That inventory was allowed to just keep on building out there. And the inventories are in a different place. I mean, if you look back in 2007, most of those inventories were held by the US and Russian governments. That's where they're sitting. Since then, because of the way they've been sold and the extra material that's been coming out, it's the utilities and a change of where our inventory is sitting that has made things different. We've had an industry that's been in oversupply, which wasn't the case back then. We've had to remove that oversupply, but that oversupply created as inventory oversupply. And what we've been seeing for the last few years is a gradual unwinding of that inventory oversupply. And back to our earlier discussion on this, I think that's what is different now. Why what we're seeing with COVID-19 is not just a head shake, that it's, guys starting to look at it and going, I can't afford to have these guys starting to not be in the market. And therefore I have a risk of supply. I need more material. I can't, stand on the side.
Okay. So it's that initial pushing of the boulder, so to speak, overcoming that price inertia to get the spot price moving.
Absolutely. And we're continuing to expand the deficit for this year. This expands that deficit this year that most people are predicting by having material shut down. I mean, I saw one of the commentators putting the number that's disappearing because of COVID-19 somewhere between 7 and 15 million pounds. Well, that's a big chunk of annual production that's being taken out of an industry that was already going into deficit. And we're predicted to be in deficit next year. I mean, next year you lose the Cominac mine in Niger. So, you're expanding that deficit problem. And so where do you meet the material from? You just take it out of inventory, whatever. So we are pulling this inventory level down. And as I said earlier, that fungible inventory is actually not that big. Most people there are inventories out there, but most people are holding inventory because they need it for strategic reasons. So there's not a lot of spare, loose inventory just floating around that nobody really wants.
Daniel, you often point out that in the last uranium cycle, some of the best performers were the development companies that were on the verge of coming into production. You have 3 development projects in Mali, Niger, and Zambia. Are you still on track to kind of capitalize on this expected bull cycle we're entering with your company?
Yeah, I believe we are. The one thing we've never done is stop moving forward. At Madawiela, we had, back in 2018, end of 2018, we made it very clear we would start our feasibility study. We felt the fundamentals to the market were moving forward. Last year, we revised the way we were working to a degree to make that actually a pre-feasibility study first, and then move that into a feasibility study. The rationale for that change was that the changes we were seeing to our model was so great in the way that we were changing process design, the way we were able to now bring in contract miners, the way we were looking at restructuring the project to make it bankable, that we decided that we really needed to put a PFS out first so that we could continue our conversations with potential off-takers and with potential lenders. And then we would just continue down that path. Now, that work is still ongoing. We did press release the other day that we've been caught out slightly with the lockup in South Africa, where we'd just done a whole bunch of test work, and unfortunately the lockup meant the material was in the wrong building for it to be assayed. So the test work's been done, we just can't get the assays done until we can move it from one building to another across Johannesburg. But what we're doing with that is actually just making sure that the project keeps going forward. So we're not sitting on our hands. We already had provisional test work previously on the same subject that gave us an answer. And so we have assumed those numbers, and our project is still going full on, and we will adjust when those test work results come back. So we had predicted May. We probably are looking at as now a June finish, but that will depend on how the lockup continues to affect us. But the message is no, GoviEx hasn't stopped. It keeps moving forward on its project, and it's all about making our project bankable in all facets. That's not just about making it have a nice IRR or NPV at a uranium price. It's about having something that I can take to the banks and saying, can you finance this? Does this meet all the criteria regarding resource tails, payback periods, technical risks, all of those things? So we're looking at the full suite of everything that goes in. So a lot of the changes on the project, for example, are taking out technical risk in the project that we had in from technologies. We're going into a contract mining operation, which obviously does have an impact on our operating costs, but we make a big saving on our capital costs. But what you're paying to move rock now. You're not making your own assumptions. So again, it changes the risk balance of what you're trying to do. So no, we have that mining permit fully in play. We've got a great relationship with our government in Niger. They're very keen for Madawiela to get going. Obviously, the Cominac mine next door is due to close in March of next year. And our target we'd like to work with the government on that to make sure that we're at a construction phase by March. Obviously, that's driven by the price of uranium and our ability to access the financing by then. But, we try and work with the government as well to support Niger.
On the financing note, you kind of were a victim of the unfortunate situation about a month ago when all equities, and I've seen it in gold miners too, that had to cancel or restructure their financings, and you had to cancel the second tranche of your private placement kind of at the bottom. Where are you at with financing for the rest of this year now that things have picked up?
Well, the first point I'd make on that financing, we were actually doing it at a premium to the market, a fairly substantial premium to the market as well. And we were offering a one year lockup at the stock as well. So it wasn't normally the 4-month lockup. We'd extend it to a 1 year. So it was
with a 5-year sweetener on the warrant, right?
You had the warrant, yes, but you were still having to pay a premium to the market, and a fairly substantial one, and you had the lockup. So there were many facets of that were good. We got the first half of the first tranche away. That was great. With everything going all over the place, we have focused on doing what we do, which is get that PFS out. So we're not standing still. We're still moving forward. All we've done is just cut costs everywhere else to make sure that we can get through into the second half of this year, which is by when we hope to have had that PFS out with the existing financing. And everything else, we just hunker down. We've cut all travel. Everybody's cutting budgets to the minimum. To make sure that we can make the funds last as long as possible. We want to see the share price go up.
And so as we conclude here, you want to just recap for us the key catalysts that investors should look for in GoviEx for the remainder of 2020?
Well, obviously, your key thing, keep watching this market. I think we have seen a real step change. I think the production cuts that have been announced are going to continue for a while. The market has responded, and that just shows you how tight this market is getting. In the case of GoviEx, we've always said that when the market recovers, we will be getting ready to go into that construction phase. So look for us in the middle of the year to get that PFS out. We're hoping that we can show a PFS that's way better than the last one. And with that, we can then continue to accelerate the work we've been doing on financing and offtake, on the whole benefit of, our target is always to get Madawiela into production, and our key benefit is that permit.
You've been listening to Daniel Major. He's the CEO, Chief Executive Officer of GoviEx Uranium. Daniel, thanks for coming on the show and providing us this update. I really appreciate it.
Thank you, Bill. Thank you.